Today, I'm going to share 3 secrets with you, but I've got to warn you that this video will likely change the way you see the Federal Reserve, and it'll change what you think is going to happen in 2024. So if you're someone that can't handle the truth, this video is not for you. I would turn off the video right now and do something else. But for those of you who want to continue watching, I want to start by asking you a question. Let's just assume for a moment that you own a bank. And the average Joe out there is asking for a loan because he wants to buy a rental property. We can all understand this. And currently, you're asking a 10% interest rate, and the average Joe wants to borrow $100,000. But this rental property that Joe wants to buy will give him a return of 20% on that $100,000 that he's asking for. So the question is, would you lend him the money? Would you lend him $100,000 at 10% interest if this asset that he was going to buy, or maybe a business that he was going to start, would give him a 20% return? I'll even sweeten the deal. Let's say that Joe comes to you with a business plan or some projected financials for this rental property, and he shows you that the market is hot right now. All of his potential customers are flushed with money. They all have jobs. Or maybe the rental market in his local area is really on fire because the economy is booming. All of these people have money to pay rent or to buy his product. Now, how excited would you be about giving him that loan for $100,000? I'm guessing that for most of you, this is a no-brainer. Of course you would do the loan, and you'd probably do the loan even at a 15% interest rate because you knew that the probability was very, very high that Joe was going to pay you back. But what if Joe were to come to that bank that you own, we're calling it UBank, and asks for another loan, but this time the environment is much different. This rental property or business that he wants to buy with this $100,000 loan is going to yield him a 0% return. The economy is doing very, very poorly now. All of those renters are gone. All those potential customers are now unemployed. So they don't have the money to buy Joe's product or to rent his rental property. Now are you going to give him the loan? The answer for most of you is going to be absolutely not, because the probability that Joe pays you back is very, very low because the economy is doing so poorly, he can't get a return on that potential investment. So then the question becomes, what are you going to do with that balance sheet capacity? In other words, what are you going to do with that money that you could have lent to the average Joe? Well, you want to get a return on it, obviously. So you're going to look for something that has good risk reward. And in a bad economy, that would likely be something like a 10-year Treasury yield. So unfortunately, this 10-year Treasury yield is not paying 10%. It's paying 5%. In fact, so many banks are doing the exact same thing you're doing because they cannot see any good loans that they would like to make. The demand for 10-year Treasuries has gone way up. Therefore, the price has gone up and the yield has gone down now to only 3%. But let's think about this, because if the yield on the 10-year Treasury goes all the way down to 3%, that will mean that interest rates overall, like mortgage rates, would come down as well. So let's just assume for a moment that Joe comes back to your bank and asks for a loan, but this time you could make a small margin if you lent him the money at 5% instead of 10%. Would you do the loan now? Although the interest rate is a lot lower, the conclusion is the exact same. Because if the opportunity for Joe to make a return on that money is still 0, regardless of the interest rate going from 10% down to 5% on the loan, the risk reward still doesn't make sense. So you would continue to go in there and buy treasuries, even at a lower rate than 3%, because it's better than getting 0% and at least you know you're going to get paid back. And unfortunately for Joe, as you can see by this distraught look on his face, he's been denied once again. But let me throw you a little bit of a curveball. Let's just assume for a moment that the Fed drops rates. Let's assume the rate right now, the Fed funds rate, is around 5%. And they drop it all the way down to 1%. My goodness gracious. So now, let's say 10-year treasuries, as a result of this influence from the Fed, go down from 3% to 2%. Let's say they're 50 basis points right now. And that means that that mortgage or that loan that you can give to Joe and still make a spread is now 1%. Would you give it to him? The answer, of course, is still no, because the economy is doing so poorly that Joe isn't going to realistically be able to pay you back. He's not going to be able to get a return on that money you're lending him. So the first secret I want to share with you, which I think is crystal clear after going through this thought experiment, these questions and answers, is interest rates are a signal, first and foremost, of what's going on in the economy, not necessarily a prediction of what the Fed is going to do next.
The second secret I'd like to reveal to you today is about money printing. Let's go to a chart of M2 money supply growth and consumer price inflation as measured by the government, the CPI. It goes all the way back to, before 1920. But I want to focus on 3 time frames in particular. Let's start by looking at the GFC. The red line indicates that in 2009, we actually had consumer price deflation, meaning that prices went down periodically. But let's look at what happened to M2 money supply during the exact same time frame. Did it go down? No, it actually went up. Now let's rewind even further and go back to the late 1940s. We can see that in 1949, again, we had consumer price deflation, almost negative 3%. But did we have a decrease in the money supply? Answer, no. The money supply was still increasing. Then we go back to the last time in U.S. history when we had the money supply actually decrease. This was a time frame that all of you are aware of. It was called the Great Depression of the 1930s. And we all know that this was definitely a time of consumer price deflation as well. So now that we've looked at those times in history, let's go ahead and fast forward to what's going on today, right now as we speak. So most of you know that the current inflation rate is right around 3.5%. But what's happening with M2 money supply growth? Is that going up by 5%, 10% year over year, like we've seen kind of a historical average in the United States? No, it's actually decreasing, just like it did during the 1930s. And like I said earlier, the only other time in the past 100 years where the money supply has actually decreased is when we had massive amounts of consumer price deflation, not due to a recession, but due to an economic depression. And we see the exact same thing playing out with the money supply in the United States today. So secret number 2 about money printing is if you actually look at the data, you see the opposite is happening. Money supply growth is not increasing, it's decreasing. I'm not here to say that it's going to last forever, but currently the money printer is working in reverse.
The third secret I'm going to reveal to you is a secret about quantitative easing. And I can promise you, this is something the Fed doesn't want you to know. We're going to go through this, and then we're going to connect the dots from all of the secrets we've discussed today. And at the end of this video, you'll discover why I think 2024 will play out in a way that very few of you expect. So let's start by looking at this, well, what's supposed to be a pie chart. These circles are actually very difficult to draw on the whiteboard or draw them well. But editor, go ahead and throw up the actual pie chart. And this goes back a few years, but let's just assume the ratios are similar to what we have today with the over 30 trillion in federal government debt. So domestic entities own around 73% of the overall treasuries or government debt. Breaks down non-banks around 16, banks 15, government 21, Fed 19, and foreign entities own around 26 or 27%. So let's assume moving into 2024, we have a recession. I think for most of you, that's your base case. Well, we know what the Fed's going to do. They're going to do more quantitative easing, just like they've done in the past during the GFC, cerveza sickness, etc. When all you have is a hammer, everything looks like a nail. I think it's going to be a monetary version of that Saturday Night Live skit where the solution to every single problem is just more cowbell.
I got a fever, and the only prescription is more cowbell.
With the Fed and the central planners, the solution to every problem is just more quantitative easing. So the real question we need to answer is, how is this quantitative easing likely going to impact M2 money supply, or the amount of currency units that are out in the real economy chasing goods and services? Let's take it to an extreme and assume the Fed is going to buy every single treasury they possibly can. A lot of these foreign entities aren't going to sell. A lot of the domestic entities aren't going to sell either. But at the right price, they are going to have a lot of these entities that want to sell. So just to make things easy, let's assume that the Fed buys everything that they can, 100% of what they can domestically, because that would roughly balance out the entities in the two different categories that would be unwilling or unable to sell their treasuries. So if the Fed goes to the banking system and says, look, we want to buy everything you got, that 15.6%, we want it. What happens to M2 money supply? Zero. Nothing. So the Fed, let's just assume for a moment that this is around $4 trillion. So the Fed's balance sheet would increase by $4 trillion. Very similar to what it did during the cerveza sickness. But what they would do is they would buy those treasuries by giving the banks bank reserves. So nothing would happen on the liability side of the commercial banks' balance sheets. And I know a lot of you right about now are saying to yourself, okay, George, well, if they have additional bank reserves, then they're going to lend more, they've got more balance sheet capacity, and that is going to have a positive impact on M2 money supply. Well, first and foremost, the banks don't need bank reserves, so it's pretty much a nothing burger to start. But that's a topic for another video. But this also assumes that there's going to be demand for loans and that the banks are going to be willing to lend based on the risk reward. Remember secret number one. More on that in just a moment. But now let's think through what happens if the Fed buys all 16.6%, we'll call that 4 or 5 trillion, from the non-bank entities. Well, this will definitely impact the amount of currency units. In fact, it would increase it by the $5 trillion. Because when a bank buys something, an asset from a non-bank, regardless of whether it's the Fed or JP Morgan, the commercial bank liabilities go up. And commercial bank liabilities are just another name for customer deposits, which is just another name for M2 money supply, which is just another way to say the amount of currency units chasing goods and services in the real economy. But this is just the impact that the Fed would have. What about the commercial banks themselves dealing with their own customers? So we go back to that example that we used in secret number one, where the bank is lending money to the average Joe. Well, this is where the majority of the quote-unquote money or currency is created. It's lent into existence. So setting aside what we just talked about with the Federal Reserve and doing quantitative easing, if the bank extends a loan to the average Joe, and on net balance, the amount of lending increases, the amount of currency will increase as well, all else being equal. But what happens if we go into a recession, the banks are risk off. There's no demand for loans because there's no opportunity to make a return on that money that you're receiving from the bank. Well, then on net balance, bank lending decreases, and therefore the amount of currency units also decrease. So now let's go ahead and combine both dynamics at play. We've got the Fed, in this case, if they buy everything, all the treasuries from the non-banks and the banks, increasing M2 by about 5 trillion. But editor, go ahead and throw up a chart of what bank lending does during a recession. And we can see that it plummets. So if you are to assume that we go into a severe recession, if not depression, in 2024, we must also assume that bank lending on net balance will go down. So very simple math here. Let's just assume that the Fed increases M2 by 5 trillion, but bank lending goes down by 3 trillion. I think those are very realistic numbers. Okay, well on net, we have an addition of $2 trillion, which would be roughly 10% of existing M2. But wait a minute here. We've talked about an increase by that exact same amount earlier in this video, if my memory serves me right. In fact, editor, go ahead and throw up that chart of CPI and M2 that we went over in secret number 2. And in 2009, when we had consumer price deflation, year over year, the amount of currency units went up by 10%, the exact same amount. So secret number 3 is if, or maybe when, the Fed does quantitative easing in 2024, it doesn't necessarily mean that we're going to get consumer price inflation. In fact, if history is a teacher, we could see consumer price deflation as a result of what the banks are doing that counter what the Federal Reserve is doing. I think it's very safe to say that in a scenario where the Fed is increasing their balance sheet by $5 trillion, the banks will be lending a lot less. So I think what will likely play out in 2024 that I would bet very few of you are expecting is, regardless of the Fed dropping interest rates, printing money, and doing quantitative easing, they're going to have to fight deflation, not inflation. And what this also means is the 401k, the stocks, the home equity is likely going to come down as well, while unemployment, unfortunately, will go up. Let me be very clear. I don't think that the 2020s is going to be like the 1930s and be a deflationary decade. I think it's going to play out a lot like the 1940s, where we have these huge spikes of inflation, but we have temporary waves of deflation as well. I'd like to remind everyone that in 1947, inflation was north of 19%. And less than 2 years later, it was negative 2%. We go from 19% inflation to 2% deflation. Unfortunately, that's the economic roller coaster ride that I think we're going to be on for the rest of this decade. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.